Yes friends, now let us discuss about the other notified cases of Rule 32. We are done with your first notified case of Rule 32, which was money changer, that is banks and authorized dealers. The other notified case, the next notified case is air travel agent. Rule 32 sub rule 3, it is talking about your air travel agent. Friends, be very clear that we are trying to find out the value. Whatever answer we are finding, it is of value, not GST. Value multiplied by the rate will be giving you GST, but whatever answers we are finding, whether it is in rule 31A or 32, it is only the value. Now friends, another important thing here is you are talking about air travel agent, not the airline company. We are not trying to find out the value for the airline company. We are trying to find out the value for air travel agent who is into the service of booking air tickets. So this valuation is not for the airline company, it is only for the air travel agent. Now, if the air travel agent is booking tickets within India for travel within India, domestic bookings, then assessable value is 5% of the basic fare. 5% of the basic fare. Whereas if the air travel agent is booking the tickets for international travel, international bookings, then the assessable value is 10% of the basic fare. Now, a very important point, basic fare means only the fare on which commission is normally paid by the airlines to agent. It will not include other charges. It will not include other charges. So, only on basic fare you have to calculate your GST, not on other charges. Now, let me take an example for that. Supposing the basic fare given in the question is say 1 lakh. And other charges, air travel tax, even travel tax will be there. Other charges say it is say 5,000 and air travel taxes say 10,000. 10,000. Now, how are you required to find the value, assessable value for the? You are trying to find out what? You are trying to find out assessable value for air travel agent. If you are trying to find out assessable value for air travel agent, and if I tell it is domestic bookings, then it will be 1 lakh, only 1 lakh, take only 1 lakh multiplied by 5%. And if I tell it is international booking, it is for travel from India to outside India or vice versa. Then if it is international bookings, it will be same, again basic fare is 1 lakh multiplied by 10%. So while finding out assessable value for air travel agent, you please take the base only as basic fare multiplied by 5% for domestic bookings, basic fare multiplied by 10% for international bookings. These other charges and air travel tax will not be included. Yes, if at all I tell that it is an additional information, what is the assessable value for the airline company? Assessable value for the airline company, here it is 1 lakh plus incidental charges 5,000 plus taxes other than GST 10,000. So for the airline company, the value will be 1,15,000. That will be the value for the airline company. This is in terms of section 15 subsection 1. Whereas here we are talking about which provision? This, for airline company you are taking the provision of section 15 subsection 1. For the air travel agent you are going by section 15 subsection 5, rule 32. Rule 32. So that's the difference. We are not talking about airline company here. Airline company is normal valuation. 1 lakh price paid or payable, incidental expenses 5,000, 10,000 it is taxes other than GST, you are going to add it, everything. We are only focusing on air travel agent, which is covered by section 15 subsection 5 notified supplies, rule 32. Right. So that is the situation. We are done with this rule 32 sub rule 3. Now friends, the next notified scenario is life insurance company. A very important point to note, here you are not talking about life insurance agent here, normal valuation, you are talking about life insurance company, rule 32 sub rule 4. So a very important point here, the focus is not on LIC agent, the focus is on life insurance company. In the previous case, the focus was on air travel agent, it was not on airline company. Now in this case, the focus is on life insurance company, not life insurance agent. In this case, the focus is on life insurance company and not the life insurance agent. Now, when you talk about that, life insurance, again, the important point is it is not about LIC agent, plus it is not about general insurance company, it is only about life insurance company. There are various situations here. If at all I tell that the premium collected by the life insurance company is only having risk portion, there is no savings portion. Normally with the premium collected by the life insurance company will contain a risk portion plus a savings portion. Savings portion, they will assure you that they will give you this amount plus certain interest, savings portion. Now if I tell that the premium is only having risk element, no savings element, then entire premium is the assessable value. Entire premium is the assessable value, gross premium. Right. Now the second category of premiums can be, I can tell that the the premium contains both risk element as well as savings element. So premium, if it is say 1 lakh rupees, part of it is risk element, risk portion, which you may get higher or lower, or you may not get anything. Savings portion is the assured amount you will get plus the interest on the same. Now if that is the scenario, then you have various permutation combination. If the savings portion is intimated to the policy holder, if it is only containing risk element, entire value, entire premium is assessed value. If it is risk plus savings, then ask one more question, whether the savings portion is intimated to the policy holder in the beginning. If it is intimated to the policy holder in the beginning, then assessable value is equal to the entire the entire premium minus the savings portion. If I do that entire premium minus the saving portion, friends, I will get only the risk element. I will get only the risk portion. Gross premium minus the saving portion. If the investor, if the person who is investing in the LIC policy holder, he is intimated that, see, this is your risk portion, this is your saving portion, then the life insurance company will pay GST only on the risk portion, that is gross premium minus the savings portion. Gross premium minus the saving portion is nothing but the risk portion. Another scenario is possible that savings portion is not intimated to policy holder. See, premium contains both risk plus savings, but it is not intimated. What amount is risk portion, what amount is savings portion is not intimated. Then you have to ask whether it is a single premium annuity case, only one time premium you have to pay. In that scenario, assessable value is equal to 10% of gross premium. If at all it is a scenario where you have to pay premium year by year, you are not going to pay one year premium. Single premium annuity means once you have paid one premium, you need not pay any time more. It is only one time premium paid policy. You have to pay premium only once, and that will be a big amount. Therefore, assessable value will be 10% of gross premium. And if it is a scenario where you have to pay premium year by year, for the first year premium it will be 25% of gross premium. For the next year, second year, third year, fourth year, it will be 12.5% of the gross premium. 12.5% of the gross premium. Now to take this or to understand this better, assuming that life insurance company, LIC company, has got a total of premium of say, total gross premium of say 100 crores. A particular LIC company has got a gross premium of say 100 crores. Out of that 100 crores, assume that 10 crores premium contains only risk element, only risk portion, and balance, what is the balance amount? Balance 90 crores contains savings portion plus risk portion. Now in this scenario, for the first part where 10 crores is only containing risk portion, the answer is pretty clear. Assessable value is equal to entire 10 crores. In the second scenario where the 90 crores contains risk portion plus savings portion, again you have to ask a question, whether it is intimated. What is the risk portion, what is the saving portion, is it intimated to the policy holder? In the first scenario I am taking it as intimated. Supposing out of that, out of 90 crores, in 30 crores it is intimated and 60 crores it is not intimated. In 30 crores it is intimated that your risk portion is so and so and savings portion is so and so. In 30 crores it is intimated and it is said that the savings portion out of 30 crores is 10 crores. So in this scenario, assessable value will be gross premium 30 crores minus the saving portion 10 crores, which is 20 crores. Which is 20 crores. And balance 60 crores, it is not intimated. Balance 60 crores, it is not intimated which one is risk portion, which one is savings portion. So again you have to ask a question. What are all single premium annuity policy, what are all normal policy? So if at all I am talking about single premium annuity policy, let us assume that it is 10 crores. Others other than single premium annuity policy, it is 50 crores. right? So for single premium annuity policy, friends, assessable value will be equal to 10 crores multiplied by 10 percentage, 1 crore, 1 crore. For other than single premium annuity policy, which means that you are going to pay premium year by year. See, understand that when that life insurance company gets at 50 crores, few of the policy holders would have been paying premium for the first time, and few of the policy holders would have been paying premium for the second year or for the third year or for fourth year. So that 50 crores, will further contain two categories: first year premium, second year, third year, fourth year premium. Assume that the first year premium is 20 crores and the second year, third year premium is 30 crores. So for the first year premium, friends, assessable value is equal to, so you have to take the 20 crores multiplied by 25 percentage, and for the second year or third year or fourth year, whatever it is the premium, you have to take assessable value is equal to 30 crores multiplied by 12.5 percentage, right? So that is how you have to calculate. So if you see this example, everything will be pretty clear. I mean, I've taken a very practical example where if it is only risk portion, entire amount is the premium. Where it is risk portion plus premium savings portion, and it is intimated to the policy holder that out of 30 crores, 10 crores is the saving portion. So you have to take 30 crores minus 10 crores savings portion. Risk portion will be subject to tax, assessable value. Where it is risk portion and savings portion, but the same is not intimated. The same is not intimated to the policy holder. And if it is a single premium annuity policy, 10 crores multiplied by 10 percentage. If it is a multi-year by year premium annuity policy, if it is first year premium, take that first year premium multiplied by 25 percentage. If it is second or third or fourth or fifth year premium, take that amount multiplied by 12.5 percentage. That is how you have to calculate. So we are done with your rule 32 sub rule 4, where you are talking about life insurance company, how to calculate the value. Next, friends, you are talking about second hand goods, a very important point. You are talking about second hand goods. Normally when you see, you are talking about services basically in rule 32, but here you are talking about goods, second hand goods. Now friends, when you are talking about second hand goods, it is rule 32 sub rule 5, where you are purchasing and selling second hand goods, there can be minor processing but not changing the nature of the goods. So when you are purchasing second hand goods and selling second hand goods, you may do small repairs. You are not doing manufacturing or processing. Minor processing is possible but not changing the character or nature of the goods. So you may do small repairs on the same. You are purchasing second hand goods and selling second hand goods. You are talking about a second hand dealer. A classic example that you can take is second hand motor vehicle showroom. Second hand motor vehicle showroom. Now in this scenario, what are they trying to tell? They are telling that assessable value will be equal to selling price minus the purchase price. Only the margin, only the profit. But it comes with a condition. It tells that the condition, the main condition is ITC should not be availed. You should not take input tax credit on your purchases. If you are taking input tax credit on your purchases, then pay GST on the entire selling price. If you are not taking input tax credit on your purchases, you pay GST only on the selling price minus the purchase price. If there is profit, pay GST. If it is loss, then that shall be ignored. That will be treated as zero. So that is a very simple understanding of your second hand goods. A very simple understanding. Now, assume a scenario where I am talking about second hand goods. Your basic focus is on second hand goods. Now there are two scenarios. Right. Two motor vehicles that I am selling. Motor vehicle 1 and motor vehicle 2. Motor vehicle 1, motor vehicle 2. Motor vehicle 1 I have purchased for purchase prices 1 lakh and sale prices say 1,10,000. And motor vehicle 2 purchase prices 1,50,000 and sale prices 1,30,000. Now understand the scenario. If I tell that I have availed input tax credit, if I am taking input tax credit, answer is different. If I am not taking input tax credit, answer is different. If I am taking input tax credit, I am going by normal provision section 15 subsection 1. If I am not taking input tax credit, only then I am going by special provision section 15 subsection 5 where I am seeing your rule 32 sub rule 5. I am seeing your rule 32. If I am taking input tax credit, friends, the assessable value will be the selling price 1 lakh 10,000 for motor vehicle 1. Here assessable value will be 1,30,000 for motor vehicle 2. Understand that first is a scenario where you are having profit, second is a scenario where you are having loss. In second hand goods it is very common, it may be loss at times also. So if you are availing input tax credit, you go with normal provision, assessable value will be your selling price 1,10,000, 1,30,000. If you are not availing input tax credit, only if you are talking about a scenario where you are not availing input tax credit, you are going to go by section 15 subsection 5 rule 32 sub rule 5. Here assessable value will be selling price minus purchase price, which is equal to 1,10,000 minus 1 lakh, which is equal to 10,000. You are going to pay GST only on 10,000. Obviously, if you are going by this particular method, the customer may know your margin because he will do the reverse working. He will find out your margin. He will say, okay, if you have charged GST only on 10,000, then he will think that, okay, if you have gone for this method, 10,000 is your margin. So there is a possibility that, high possibility that customer can easily find out your margin. So that is the negative side of this particular rule 32. Now, in the second scenario, selling price is 1,30,000, whereas the purchase price is 1,50,000, which means you are having a loss of 20,000. You cannot net off both the transactions. Here it will be treated as 0. If you are having a loss, it will be taken as 0. If you are having a profit, pay GST on that profit 1,10,000 minus 1 lakh. If you are having a loss, immediately do not see the negative figure, make it as 0. Make it as 0. Right. So that is how you have to calculate. You cannot sell that, okay, in this case profit, in this case loss, I will net off both. No, because GST is on transaction basis. So for the first transaction you will pay GST on 10,000. For the second transaction you will not pay any GST. So that is how this works. And friends, in this scenario there is a special situation that may arise when you are talking about basically hire purchase. Now purchase price in special case, you have a special note where you may have to find out purchase price in special case. This happens in case of repossession. Hire purchase, it is very common. Supposing the goods that are sold to you are repossessed from an unregistered defaulting borrower. If you are not making the installment payment, I am taking the goods back. I sold you the goods, you did not pay the installment. You said that you will pay in installment. You do not pay the installment. I am taking the goods back, and the recipient should be unregistered defaulting borrower. Then purchase price in that scenario, what I will do, I will repossess the goods from you and I will give it to the next customer. See, I sold you new vehicle, you promised to pay on installment, hire purchase or installment, you did not pay. I took back the vehicle from you and I am again selling you. I am again selling not you, I am selling the next person. In that scenario, that motor vehicle which I am repossessing from you and selling becomes second hand goods. Now for which, when I took the goods from you, repossessed the goods from you, I did not pay you anything. So that difficulty will be how to find out purchase price. You are talking about repossession, how to find out the purchase price. Purchase price will be reduced by 5% per quarter for every quarter. So you have to take the original purchase price, reduce it by 5% for every quarter between the date of original purchase and the date of second sale. Between the date of original purchase and the date of second sale, right? And quarter for GST means always means calendar quarter. Now let us take the example to understand it. Now DK Finance Limited repossesses a bike from Mr. VK, which means DK Finance Limited initially, the bike was sold to VK and VK did not make the payment. He defaulted in making the payment, right? Now the bike was purchased in April 21. And when it was purchased for 1 lakh. When it was purchased, it was purchased for 1 lakh. The company, DK Finance Limited, purchased it for 1 lakh. The company repossessed the bike in July 2021. So, bike was purchased in April and sold in April to VK. VK did not make the payment. Therefore, DK Finance Limited repossessed the bike. When the bike was purchased in April 2021, the purchase price was 1 lakh. And the bike was repossessed in July 21. When VK did not pay the installment, and the same bike was sold in November 2021 for 90,000 rupees. Now if I were to tell this in a very clear pictorial presentation, so you are talking about DK Finance Limited, who sold the bike to VK, who should be unregistered, right. Now initially purchase was made by DK Finance Limited in the month of April 2021, and the purchase price at that point of time, the purchase price was 1 lakh. It was sold to VK. Let us assume that it was sold same month. It was sold in say April 2021 or May 2000, same month it was sold. It does not make a difference whether it was sold in April 2021 or May 2021. VK did not make the payment of installment. Therefore, this was sold. Now it is repossessed. Now when it is repossessed, DK Finance Limited will not pay anything to VK. Already some installment is paid. After that, it is not paid. So when it is repossessed in July 2021, nothing is paid. Nothing is paid. So DK Finance Limited will not get any amount. VK would have paid few installments. VK would have paid say 2-3 installments. When it is repossessed, repossession price will be 0. Right. Now the same DK Finance Limited will resale the goods. Resale the same motor vehicle. Understand friends, when it is resold, it becomes second hand motor vehicle, isn't it? Second hand goods. When the same item is sold, it becomes second hand goods. Now when it is resold in the month of November 2021, and it is selling price now is 90,000. Now friends, understand that if you are valuing it under, if you are doing valuation under rule 32, it tells that assessable value will be equal to your selling price minus the purchase price. Assessable value will be equal to your selling price minus the purchase price. Selling price is clearly known. Selling price is 90,000. Selling price is 90,000. The question is all about your purchase price. What is the purchase price? Because the focus is on this purchase and this sale, repossession and resold. Sale price is very clear. So when you're talking about your sale price is 90,000. November 2021, 90,000. Sale price is 90,000. What about the purchase price? The question actually revolves around the repossession price, which actually the DK Finance Limited will not pay anything. As the customer VK did not pay the installment, the goods, the motor vehicle is repossessed. The issue revolves only and only around the purchase price. You have to calculate it. Now in this scenario, they tell that for purchase price they have a formula. For purchase price they have a formula. You take the original purchase price, which is 1 lakh, which is original purchase price. Original purchase price, not the repossession price, which is 1 lakh. Subtracted by 5% per quarter or part thereof. And the subtraction of 5% per quarter or part thereof, the subtraction will start from the date of original purchase. The quarter will be calculated from the date of original purchase, April 21, till the date of second sale. Date of first purchase till the date of second sale. So July will not be considered. So depreciation, see, simple language, depreciation. Depreciation started when the bike was purchased in April 2021. So here you are going to take that 5% subtraction quarter right from the date when the bike was purchased originally, not repossessed, purchased originally April 2021, till the bike is resold November 2021. Now how many quarters are there? April 21 to November 2021. Calendar quarters, you have April to June 1 quarter, July to September another quarter, October, November part of the quarter. You are talking about part of the quarter. Even if it is 2 days or 3 days, it will be treated as part of the quarter. So 5% multiplied by, you are talking about 3 quarters multiplied by 1 lakh, which means 15%. So purchase price will be 1 lakh minus 15% of 1 lakh, which is 15,000. So it is 85,000. 85,000. Now when you friends understand that this 85,000 is not the answer. 85,000 is the repossession price. 85,000 is the repossession price. You are going to take this 85,000 and put it here. So this will be 90,000 selling price minus purchase price 85,000. So assessable value will be 5,000. Assessable value will be 5,000. So in this very typical scenario where repossession happens, finding out purchase price will be a challenge. Resale price will be very clearly given in the question, 90,000. So when you talk about the assessable value, friends, assessable value is selling price minus purchase price. Selling price is very clear, 90,000, which is given in the question. Purchase price here stands for repossession price. For finding out repossession price, what you have to do? You have to take the original purchase price subtracted by 5% for every quarter, right from the date of original purchase till the date of the last sale. Right from April 21 when it was originally purchased till the goods are resold, November 21. So here you find 3 calendar quarters. So here the answer is 90,000 minus 85,000, which is 5,000. So that is all about your rule 32 sub rule 5. Now friends, when you talk about the next rule 32 sub rule 6, it talks about what will be the value which should be taken when you talk about goods being sold or service being sold by way of token or voucher or coupon or any other stamp other than the postage stamp, which is redeemable against the supply of goods or services. Which means that if I am giving you a coupon and telling that you can use this coupon in Big Bazaar, what will be the value of those supplies? Simple. I am giving a very simple example. I am giving you a coupon and I tell that you can use this coupon and redeem it in Big Bazaar for getting the goods or services. What will be the value of that coupon or voucher or stamp, whatever you call, but other than postage stamp, which you are going to redeem it for goods or services? A very simple answer. The assessable value will be equal to money value of the goods or services that I am redeeming against such token. Whatever goods and services I am taking against that token. Supposing I take that voucher or coupon or token in Big Bazaar and I purchase goods worth 1 lakh, and out of which 80,000 I use the voucher and 20,000 I pay cash. So value of that voucher is 80,000. Value of that voucher is 80,000. Simple understanding. Against that voucher, whatever goods and services I am going to get, take the monetary value of the goods and services. Right, I repeat it. I have given you a voucher which you can redeem in Big Bazaar. Now, when you use that voucher in Big Bazaar, they allow you to purchase till 80,000. Assume you have purchased goods or services worth 1 lakh. So 80,000 you are not going to pay, because for 80,000 you are giving that voucher and 20,000 additionally you are going to pay. So what is the value of that voucher or coupon or stamp? The value of that voucher or coupon or stamp is money value of the goods or services that can be redeemed against that voucher, which means simple language, fair value of the voucher. Fair value of the voucher was 80,000. So answer here is, for the value of the voucher is 80,000, but when you purchase it from Big Bazaar, total value for Big Bazaar will be 1 lakh. 80,000 against the voucher, 20,000 you have paid in cash. So very simple understanding. This was not required. They have again just clarified it. Whatever is the fair value or the market value of the voucher, that will be the answer. So whenever actually I give the voucher, at that point of time itself I will tell, see, this voucher is worth 80,000 rupees. You can purchase anything within 80,000 rupees. So what will be the value of that voucher? Whatever goods and services you have redeemed against that voucher will be the answer. Right. And friends, there's a last rule, rule 32 sub rule 7, which we are not going to discuss because it is not of any use. It is applicable only and only for notified services, and as of now no notified services have been given. As of now there are no notified services given in rule 32 sub rule 7. Therefore discussing it is of no use. In certain for certain notified suppliers of service, for certain notified suppliers of service, only it is only applicable for notified service providers. If the transaction happens between related person or distinct persons for notified service providers, they have said that assessable value is 0, and with the condition that assessee and recipient is eligible for ITC. Now discussing all this does not make any sense, because this rule 32 sub rule 7 is applicable only for notified service providers, and as of now there are no notified service providers. So discussing it does not make any sense. We will not discuss the same. So we are done with your special valuation rules, that is rule 31A, actionable claim 32. In 32 we have discussed your money changer, we have discussed your air travel agent, life insurance company, second hand goods, vouchers. The last scenario you have not discussed, you have discussed even vouchers. So we have discussed all these cases. We are done with your special valuation rules.